a barrel. So Oliver Slopes with Blue Line Futures, and Oliver, looking at the technicals for corn and soybeans, but man, we just can't ignore what's happening in the energy market.
Yeah, we saw a little bit of risk premium being put into the market ahead of the weekend, thinking that we might see things kind of escalate from already where they are in the Middle East, and that fell short of what the market was concerned about, which is a good thing for the world. But from a commodity price standpoint, you're seeing that risk premium just get evaporated from the market. Crude oil down sharply in the overnight trade, and I think that put a lot of pressure on some of the other commodities as well, gold, silver, and the grain markets as well. When you kind of zoom out and kind of look at where we're at for the fundamental landscape as far as grains go, I still think corn is relatively constructive. We've seen a string of flash sales here over the last couple weeks, and we added 2 more this morning to Japan and unknown destinations. From a technical standpoint, we're kind of in the middle of no man's land. We've been in a range over the last several weeks between $4 at support and $4.25 as resistance, and the $4.12, $4.15 area, it's smack dab in the middle. So from a trader's perspective, probably be looking to buy lower prices or sell higher prices. Not a whole lot to do right here in the middle. Soybeans still a little bit weaker. Really concerned that Brazil and South America as a whole is going to come out with a pretty good crop, and that's going to keep the upside very limited. The 10.20 is going to be significant resistance for the January contract. Until the market's able to get out above there, I think the bears are clearly in the driver's seat there.
You know, as you kind of explain this, I'm kind of wondering, have we built in the fact that USDA has given us a target, if you will, for export sales this year? So when we're seeing these overnight flash sales, it's really just helping us get to where USDA has pegged. Is that a good assessment?
That's a great assessment, and for the corn market, you know, we need to send a big thank you note to Mexico, because they've been the primary buyer week in and week out, and continue to really support the demand side of the equation when China's been absent. And if we didn't have Mexico in the market, you know, prices could be substantially lower. But we do have Mexico in the market. I think that we're seeing good demand at lower prices. So lower prices in the corn market are doing their job. They're curing lower prices by spurring demand. Soybeans, I just don't know that we're quite there yet. We're starting to kind of fish for that demand and picking up a little bit here and there, but we need to see it on a more consistent basis at bigger numbers week in and week out.
Well, if low prices cure low prices and high prices cure high prices, what's happening with livestock? We'll find out in a moment. Market Day Report continues in a moment, too. So Oliver Slopes with Blue Line Futures, and Oliver, if low prices cure low prices, high prices cure high prices. Apparently, we're not to the high yet when it comes to livestock.
Yeah, the cattle market's been very resilient. We had a cattle on feed report on Friday that was mostly neutral. You could make the case that it tilted a little bit on the bearish side, but still holding in there pretty well. And the cash price firmed up in the 5-area average on Friday afternoon as well. And I think the market had been anticipating that firmer cash trade. We finally got that. Now we're just kind of lingering around to start the week. 190 for that December contract. That's a really tough barrier for the market to get out above, not just here recently, but over the last several months as well. That's kind of been the top end of the range where you see the market fizzle out. Whether or not we're going to be able to chew through that resistance or not, to be determined. I'm working with a lot of people that need to protect the downside. I would be taking advantage of these higher prices. The volatility has been relatively low in the cattle markets, which make options, I think, a good vehicle to layer in some put protection if you have that long exposure. The funds net long 93,000 contracts. So the risk of long liquidation is certainly there if these strong fundamentals start to fade away.
Oliver, I'm just wondering here, as we move to the expiration of that October contract for live cattle, do we ever hit a situation where we don't get convergence with the cash?
That does happen from time to time. The basis swings have been, pretty wild for the cattle market really throughout this year's trade. So it'll be interesting to see how that all pans out. Again, ultimately, I think that we probably hit a little bit of a ceiling in the live cattle market. Feeder cattle, I think you could probably even more so make the case that we've hit a ceiling, as they've kind of lagged the performance of live cattle over the last several weeks, kind of lingering around. I think 250 on the top side and 242 on the downside are going to be the big levels to keep keep that January feeder cattle market in check. We talked about the fund positioning in live cattle. I think even more concerning than that is the fund positioning in lean hogs. They're net long about 93,000 contracts. Their largest net long position in the last 10 years, 96,000 contracts. So again, the risk of long liquidation in some of these protein markets is getting up there.
Well, it'll be interesting to kind of watch where we go with this. Oliver, thanks for dropping by this morning. We'll see you back here on Thursday. Oliver Slopes with Blue Line Futures. We did mention export.